A lot of people still think you need a perfect credit score. I see it all online. How to fix your credit, repair your credit, get your credit to a certain spot so that you could buy a home. Back in November of last year, 2025, Fannie Mae updated its underwriting algorithm, if you will, to not dispel credit, but to make the decision on if you should be able to be approved for a home loan going the conventional route by other factors. And now your credit doesn't matter. So today I want to go into what Fannie Mae has done, what we as lenders have always known. And I want you to understand that you don't have to have a perfect credit score. In this case, you don't have to have a credit score. Let's delve into what has changed and how you can use the information to help you buy your next home. Leg up. What actually changed? Previously, DU would say, hey, these three numbers, AKA credit score, you have to have a minimum of a 620. That was baked in their decision-making process. Well, now DU uses more criteria, a broader risk model, if you will, to help those of you that may have not met the past criteria. Now, I've heard a lot of conspiracy theories online saying this is akin to the things that created the housing market crash that started back in 05, 2005, culminated in 2008, and the residual fallout through 2013. And I'm here to tell you that's not the case. That's not what's going on, because now that the algorithm has been updated, it's probably going to approve another 5 to 8% based upon what the experts are saying. It's really designed for those people that are unbanked, but they have the criteria, they have the right metrics, if you will, to say these folks are great potential home buyers to take the risk to lend money to. So before we move forward, I'm not saying credit doesn't matter. I'm not saying if you've been negligent and haven't handled your credit properly that you're automatically going to be approved, and therefore we're not going to see all of these bad loans coming down the pipe, because you still have to qualify. You have to have a qualified mortgage profile in order to get a loan. Hopefully that makes sense. And the next thing I want to deal is what lenders really look at, what we look at as lenders to really make a decision on if you are a great candidate to borrow money. And if you take this information to heart and write it down and follow it, you'll also have an excellent credit score. But again, it really doesn't matter anymore. As a lender, the things that really matter for us helping make the determination on you as a great loan candidate is, the first thing I would say is your debt to income ratio. And more folks are fixated on the credit score, but the DTI is more telling than anything, because if you have a debt to income ratio, back end, front end ratios that are in line with industry standards or better, that is a great canary in the coal mine, in that you'll have a great buying experience and you'll be able to deal with the ebbs and flows of taxes and insurance and maintenance when you buy a home. Another thing that we really look at are reserves. Okay. And here how I'm going through this list, and it really makes sense if you think about it. So if you're not overextending yourself, your debt to income ratios are in line. Okay. And now you also have reserves. What are reserves? That's money that you have that you can touch. Uncle Dave says an emergency fund. Other people might have coined it differently. Bottom line is this: it's money that you can touch without going through a lot of red tape or being penalized because it's for your future self, i.e. retirement. Savings accounts, money market accounts, T-bills, stock market, crypto, anything that could be liquidated that you can touch. So the more reserves you have, the better. But when it comes to mortgage lending, here's a key. Here's a jewel for you off the top. When you're buying a home, let's say your home monthly payment, principal, interest, taxes, insurance is $2,000. Okay. After you've closed on the loan, meaning your down payment and closing costs, all those things are done. You signed all the documents. Now you're in the home. Anytime you can have 3 months or more of your principal, interest, tax, and insurance payment left over after you've closed your loan, the better. We call those compensating factors, right? Money is always, cash is king. I think that's the way they say it. So keep that in mind. So number one was debt to income ratio we look at. Second thing is, do you have reserves? The third thing is, I would say, is your consistency. Consistency in what? On how you pay your bills, consistency on your income flows, consistency on how you manage debt, your utilization on your credit cards and things of that nature. All those things are being looked at, okay? And so if you can understand that up front, this bodes well for you when it's time for you to buy a home or get onto the property ladder. Job history, something else that we look at. Here's the deal. You don't have to have been on the same job as a W-2 employee for a 2-year history consistently, or not, I won't say consistently, but on the same job. You can have had different jobs. But think about it. If you're someone that's looking to borrow hundreds of thousands of dollars and every month and a half you have a different employer, over a 2-year period, there's 25 different W-2s. Well, what does that say? Well, it might just be, you're somebody moving up the ladder. There might be a bigger story to that, but just from the 10,000 foot looking down, it speaks to instability or lack of consistency, right? And if you don't have the money coming in consistently as a lender, do I want to lend you all this money? Because the goal is to get it back with the interest, okay? And you determine how much interest you want to pay, really. But job history is something that's looked at. Now, here is a new one that has not been looked at, and now all of the credit algorithms are starting to put more weight on it because it's a better indicator, in my opinion, on if you can afford a home or how you'll pay for a home in the future, just as far as making the monthly payment, and that's your rental history. And so rental history is a very important thing. I just talked with a home loan consultation, and long and short, it came down to there was an issue with documenting rental history for a particular program. Okay. And so here's the takeaway. Documentation, when you're looking to borrow money for a home loan, here's the deal. It's best if you have a checking account, savings account, and your income goes into the savings account. It could be documented, the source of the income, right? How much and the frequency and consistency. Then from there, you take your $1,000 rental payment and you send that payment to the landlord or the apartment payment servicer company, where have you. But it should be consistent when you are looking to buy a home. A lot of folks, if you're staying with family members, you want to take cash. Okay. I want to take cash from the bank and buy a money order and give it to my whoever, aunt, sister, uncle, whoever you're living with, right? The problem with that is, where'd the cash come from? Documenting, you always have to have a paper trail, and it has to complete the loop. So cash in documentation world is not king because we don't know what the source is. So always keep that in mind. But rental payments, 12 or more, okay, 12 consecutive months or more is key. And make the payment be the same, consistent. If you pay in installments of 2, make the installments match. Get the money order from the same place, because we're trying to establish a consistent pattern of you paying the rent. Hopefully that makes sense. Now, late payments. Here's a big one. Should you really be borrowing money if you have a lot of late payments? I mentioned bank statements. This is another jewel for you guys. Look on your bank statements. Go back 3 months. Look over a quarter. That's a great snapshot to give you a lot of information about yourself. But if you have NSF fees, non-sufficient fund fees, or overdraft fees, first of all, is that a statement that you want to submit to someone that's looking to lend you hundreds of thousands of dollars? Probably not. More importantly, should you be looking to borrow those types of monies if there's something causing non-sufficient funds, lack of funds, or overdraw, lack of funds, right? There's an income problem. And so you want to deal with those things because this is a part of this new algorithm that Fannie Mae is using. That's not new. It's what we used to do back in the day, right? Read the documents because the numbers don't lie, okay? Your overall financial behavior. This goes back into your credit and how you handle it. Are you applying for credit cards everywhere? Are you buying stuff with Affirm, Klarna, Afterpay, and all of these entities that say, hey, I don't have the money now. I'm willing to pay a higher interest rate because I don't have what I need, but I'm not budgeting. That's what those things are saying, okay? And then I mentioned it before, compensating factors. Not only are reserves the amount of money that you have after closing, but job time, how long you've been on a job. That's a compensating factor. If you were in college, right, or some type of trade school and you finished, okay, and you have a degree, and that's going to lead to more income, that's a compensating factor. For my veterans out there, folks that are active duty or retired that have access to the certificate of eligibility, are you living in an area that has a base, that has a PX, a grocery store that you could go to on base where you're not paying taxes and things of that nature? Some of these things could bode well for compensating factors for the professional that knows how to use them. But I wanted to talk to you guys to give you some insight into letting you know, as far as conventional loans are concerned, with Fannie Mae that use the desktop underwriting algorithm, that gate of 620 is no longer going to be factored in. The things that I just went over are going to be factored in. So here's the question. If you're somebody that's able to have a good debt to income ratio, have reserves, you're consistent with income and how you pay your credit and how you borrow money, your job history is good, you have great rental history, no late payments, your overall financial behavior towards borrowing money and handling money is good, right? It's on this type of trajectory. And then you have other compensating factors. If you had all those things in place, here's the question. What kind of credit score do you think you would have? You see, when you have these things in line, the credit score is a byproduct. It's going to be great. That's why Fannie Mae isn't using that anymore. And it's going to allow 5 to 8% of people that don't traditionally bank or may not traditionally have a paper trail digitally that can show some of these things. But when we put them together, what I would call a manual underwrite, if it was an FHA loan, nothing new under the sun. But those factors, these factors are more telling to a lender when they're trying to assess risk. So hopefully all that made sense that I went over, right? So now here's the third thing. What people get wrong when it comes to the credit score, the new system, and how to move forward. Let's talk about it. So as I stated, what people get wrong when trying to prepare to buy a home and are chasing a perfect credit score, chasing 3 numbers, right? What they get wrong, in my opinion, are the things that we aforementioned, but I'm going to go a little deeper. Number 1, no savings. Savings are more important than those 3 numbers. We mentioned it before. We call it reserves. Unstable income, right, is more important than the perfect credit score, okay? High debt, having it is an issue, right? But lowering that debt is more important than those 3 scores. No plan. Oh, that one hit me. If you fail to plan, you plan to fail. And people don't realize when buying a home, it's not an impulse buy. Most of these folks that you hear lamenting bought the home for the wrong reasons. We'll put the video up here somewhere. There's a card, but there's 7 reasons, in my opinion, that deal with life that should be the catalyst for you buying a home. And when you get away from those 7 things, this is when you have no plan and failure is right around the corner. I digress. And constantly financing things. I mentioned it before, right? You always in the store. You always ringing, and when your card don't work, then you go to a firm. And after, do you notice that whenever you cannot govern yourself, there's always someone that comes up like a hero, but the interest on it is 10,000%, right? But I digress on that point also. Constantly financing things is an issue, right? So you can say a 750 credit score with no savings can still be a struggle, or a 640 score with stability and reserves may have options, or those folks have options when it comes to buying a home. Now, what the new change as far as desktop underwriting and the no score, what it doesn't mean. And this is very important, okay? And so just to clarify, your credit still matters, because even when doing these types of loans and we get an approved, eligible, and closed, we as lenders still have to supply the credit report to the investor, okay? Because there's a lot of other information there. So the score isn't the indicator anymore. And this is why I went so deep into the other variables that you should focus on. And then the score will never even matter. You'll care less about the score as you go forward, right? Late payments still matter. Okay, late payments are an issue. Collections still matter. Okay, lenders like us still have to evaluate risk. And the reason we do that is because your pricing or the rates are directly affected by your risk. Okay, anybody could get the same interest rate. You can have a 620 and an 800 credit score. They both can get 5.5%, but the cost to get that 5.5% will be more for the person with the lower score. This is why I want you guys to focus on the things that I'm going over, especially those of you that are preparing to get onto the housing ladder. So what you must remember is this: the lending industry is slowly moving away from judging people by one number and moving towards evaluating the full financial picture. If you're ready to get on to the housing ladder, aka buy a home, and you say, Robert, I understand and I'm resonating with this message, what's my next step? I'm glad you asked. Consultation. Schedule a consultation, and I'd like you to do that with me. Why? Because I'm a lender. My NMLS license number is 180100, and you can schedule that consultation by clicking the link in the top pinned comment or in the description of this video. Make sure to watch the other videos on this channel for more home buying education. Indeed, y'all stay blessed.